So now for today's strategy session, retail investors' favorite trade has come under a bit of pressure with the Mag 7 cohort officially entering correction territory. But investors who have actively managed their portfolios to move out of tech stocks have actually outperformed the S&P 500. You can see it up there on your screen. Joining us now, we want to bring in Angelo Kourkafas. He is Edward Jones, a senior investment strategist. Angelo, when you take a look at the underperformance here of the Mag 7, so those investors, I guess, that have favored actively managed funds have been able to maybe avoid some of those losses. But I think the big question for investors right now is whether or not the trends that we've seen since the start of the year, are they going to continue or if they're going to reverse on the heels of what we hear tonight? What do you think?
Yeah, I think the broadening of market leadership that we have seen, and it is encouraging for those with well-diversified portfolios, has some legs to that. There is a potential for that to continue. And I think it speaks to the resilience of the market that even with the Magnificent Seven lagging the S&P, we still have a market that is up for the year. And we thought all along that earnings will have to do the heavy lifting, not valuations, and that so far is proving to be the case. Investors can diversify and actually find areas that have this catch-up potential, even without relying only on the AI trade, which is still an important one.
So if we are seeing that diversification take place, that would also suggest perhaps that more than just a sell-off, this is a great perhaps rotation that we're seeing play out. Where's that rotation into from what you're evaluating?
Yeah, so it's rotation at multiple levels. It's been across sectors, investment styles, thinking about value versus growth, and also geographic. Europe is hitting European equities, all-time highs. Asian and Chinese equities are participating as well. So thinking about the policy mix, there is some uncertainty with tariffs, there is some excitement about tax cuts. And when you put everything together, we still think that US equity markets are well positioned in terms of some of the domestic cyclical areas can stand to benefit from these tax cuts, while growth, yes, it is modestly slowing, but remains pretty robust in the US.
How worried are you about the slowing US growth in the US and ultimately the cap that could put on equities this year?
Yeah, I think it might be a first half, second half situation where we do experience a soft patch in the first half. We did see some weakness in retail sales. The PMIs for services activity have been a little weak, and the economic surprise index is back to negative territory for the first time since May of last year. So all that suggests that we could see a seasonally weak first quarter, and that has been a pattern over the last couple of years, but then a reacceleration later on. The fact that we are slowing from a strong starting point is not as worrisome as even 2% growth for the standard of an advanced and very large US economy that can still provide a solid foundation for corporate profits to continue to rise. And that's what we've seen.
Wasn't it just yesterday that the Fed Vice Chair for Supervision, Michael Barr, was saying that the growth for the economy still relies on policy stability, and maybe I'm getting that mixed up, maybe the policy relying on economic stability, but you have things that could throw off that economic stability right now, both in the form of employment and inflation driven from any tariff impacts as well.
Yeah, no doubt there is a lot of sensitivity to what's going to happen on the inflation front. Some upside risks, no doubt. So far, we have seen some rise in inflation expectations, and that's what the Federal Reserve pays close attention to. But at the same time, they're comfortable keeping rates where they are. There's no urgency for them to cut. And looking at the labor market, it remains pretty steady. We've seen 21 months of continued wage gains exceeding the rate of inflation, and productivity has been rising, and that's a positive story. We can still have robust wage growth without refueling inflation, especially for services. Which is what is the category that's still pretty elevated.
And so how are you looking at the outperformance that we've seen overseas, particularly in Europe, and maybe what that tells us?
Yeah, it is encouraging, the fact that many people have left European equities for dead. Whenever the pendulum is swinging too far one way, it kind of self-corrects, and that's the phase we are in now. There is some hopes of Russia-Ukraine peace agreement, which could result in low energy prices. Still too early to make that call, but the fact that European and some of the other international markets were so discounted, that provided this release valve as a lot of pessimism was baked in. That said, over the last 10 years, we've seen several counter-trend rallies. So it might be a little premature to say that this is the start, the beginning of something larger. But for those investors that have been way too underweight international equities, it's a good reminder that they deserve a spot in portfolios, especially as we deal with very different scenarios on how things can play out on the trade front. If things are not as onerous or aggressive as feared, that can be a catalyst, a trigger for a continued rally, but too early to make that call.
It's a great reminder. Angelo, thanks so much for taking the time here today, just after the market open.
Thank you.
Appreciate it.